Okay, so some people have asked me, what is the difference between a market order and a limit order? So a limit order in the stock market is saying, I want to buy at this price, or I want to sell at this price. You might have a stock you already own and you want to sell it at a minimum of this price. And so that means that until that price gets hit, you're not selling out of it. So if you bought it at 10 and you want to sell it at 12, well, that means that until it hits 12, you're not selling. Even if it gets to 11.59, right? You're not selling. And a limit order the other way is, let's say that you bought it at 10 and you want to sell it at 9. It could get to 9.01, but unless it breaches that 9, it's not going to sell, right? That's a limit order. That helps you to take profits on the outside and take profits on the downside. A market order is basically saying, I want to buy or sell this stock now for whatever anyone is willing to give me for it, okay? So market orders can be good sometimes. They're also risky. And what that means is that you're willing to pay whatever the cost is. So if you put in a market order, say for 10 shares of a company that's selling for $10 generally, right? If the next person that wants to sell that stock for you is only willing, like their limit is at 11, you're going to pay 11 for the stock. If they're willing to sell it at 9, you're going to pay it at 9 for the stock, whatever it might be. Same with the sales, right? Let's say that you want to sell 10 shares of something. If what people are willing to offer is $9 or $8 or $7, that's what it will sell for. So just be careful with limit orders. They can help, but just be aware that limit orders, really, you're at the mercy of whatever the market is willing to pay at that time. It's a great way to get into a stock. If you see a stock that's rising really quickly, you might set a limit order, but unfortunately, if the stock goes above that limit, you won't get in. And so, you may have set your limit at, say, 11, but let's say the next price is 11.01, 2, 3. The market will continue to go, and you've missed out on that purchase. Whereas if you would have bought at a market order, maybe you got in 11.01, 2, 5, 7, 11.10, whatever it might be, but then you can write it up and make money. So limit orders have their place. And market orders have their place. In a rising quick market, if you're trying to day trade, you may want to take a market order because it allows you to just get in quickly while the price is rising, or to sell while the price is dropping. A limit order could be completely skipped. Because remember, limit orders work on the way down as well. Let's say you want to sell something at $10 or $9. Let's use $9 because it's a $10 stock to keep it simple. Let's say that the market goes from $10 down to $9.50, $9.40, $9.30, $9.10, and then it goes to $8.80. It'll actually skip your limit order because you didn't get 9 for it, and so the system won't sell it. But now it goes to $8.50, $8.7, and so on, and now you've lost. So now there's different strategies. There's stop limit orders, there's stop market losses. There's so many different types that you can use. But the point I'm making is, if you understand the different limit orders and market orders, you can choose what's appropriate for you based on what you're trying to do. Many people don't know this, so I thought I'd give you this quick tip. Research it yourself, understand the different order types and how they will benefit you, or the risks that they might have depending on what you're trying to do. See you next time.